There is an important correlation between the level of interest rates and the prices of residential housing. The level of interest rates in the macroeconomy will determine the mortgage rates, which is the rate at which money is borrowed to purchase a home. It tends to be an inverse relationship between the mortgage interest rates and house prices. Lower interest rates will likely increase housing prices as more people become qualified borrowers. In 2008, a worldwide housing bubble burst. Overvalued house prices resulted in high loan-to-value ratios. As house prices started to decline, the equity position in housing declined. Lenders had to start foreclosures on borrowers who were unable to keep making payments because of loss of jobs and/or inability to sell their home at a price greater than the amount owed to the bank. Many banks were in vulnerable positions of failing. Government stepped in and brokered sales of weaker banks to stronger banks. The Federal Reserve, which is the central bank of the United States, began a policy of low interest rates. This environment was in place for many years. The interest rates on home loans were at levels of 5% or even lower for quite some time. The COVID pandemic of 2020 and 2021 created an interesting economic time. The Federal Reserve kept interest rates low because the pandemic was thought to result in an economic downturn. The ability for workers to work remotely resulted in a boom in residential real estate values, and the low interest rate environment of the Fed partnered to assist the increase in housing prices. COVID created many supply chain issues in getting products to market. The lack of supply, with continuing high demand for products, created inflation, which is escalating prices in the macroeconomy. The market forces in play at the time included limited supply access, a low interest rate environment, easy access to money, and high production costs. All of these related in inflation. Inflation was seen in housing, food, and in basically all other products. Inflation was really apparent in the housing market. The housing market became very active, and values in housing escalated so that there was a lot of cash that was being accumulated in equity. In 2022, in order to slow the rate of inflation, the Federal Reserve started to raise the interest rate environment. Higher borrowing rates is a way to slow economic activity and to tame inflation. The Federal Reserve System has objectives for the macroeconomy to encourage full employment. That means that annual unemployment targets are at 3 to 5%, and to control inflation, which means they tried to keep price increases in the range of 2 to 4% on an annual basis. In 2023, inflation continued to be a big issue. The Federal Reserve policy has had a big effect on slowing residential real estate activity by raising the interest rates in the economy. Higher interest rates for borrowers attempting to buy a house means less ability to qualify for the loan needed to buy a home. A lower interest rate compared to a higher interest rate results in a big difference in the amount of borrowers that are in the market and their ability to qualify for a home loan. Low interest rates are likely to encourage borrowers to come into the market. But in a high interest rate environment, we would expect fewer borrowers. And those borrowers who can afford a home or can qualify, we would expect to see house prices would be declining in order for more borrowers to come into the marketplace. The most popular loan to purchase a residence is the 30-year amortized loan. Amortization means the monthly loan payment has two components. One is the payback of principal, and secondly, the interest that needs to be paid on the loan. Banks underwriting residential loans have guidelines they follow. One of the guidelines is that the ratio of the monthly housing debt for the principal and interest, property taxes, property insurance, divided by the gross monthly income should be 30% or less. Banks feel that this ratio is most likely to result in a safe loan for the bank. To see how higher interest rates directly result in lower housing prices, here is an example. Let's say that a borrower has monthly gross income of $10,000 per month and is anticipating a down payment of 10% of the purchase price of the house. I have simplified the details of the arithmetic of calculating the housing ratio. The bottom line is this. At a 4% interest rate on a 30-year fixed loan, the borrower can qualify for a loan of $482,000, and that would mean that they could purchase a home with a maximum price of $535,000. But taking a look at a 7% interest rate, which is the interest environment that we are in now, fall 2023, for a 30-year loan, the borrower can qualify for a loan of $345,000 with a maximum purchase price of $383,000. As you can see, that's quite a difference in terms of the person with the same monthly income, in terms of the loan that they can qualify for and the maximum price that they would be able to pay in the market. So you can see that this high interest rate environment that is being pursued by the Fed is certainly having an impact in terms of the number of borrowers, the activity in the real estate market, and what's happening to prices in the real estate market. The low interest rate environment for over 12 years, the past 12 years, has created much residential real estate activity and escalating housing prices. The higher interest rate environment that we are experiencing now has certainly slowed housing market activity and has softened housing prices, meaning that housing prices are starting to come down, and marketing times are taking much longer. In the past, some of the marketing times were just a few days. That's not the case now. Housing activity is a significant element of the U.S. economy. Where inflation is going and where real estate will be going over the next year and beyond is up in the air. Will house prices come down, allowing more borrowers to qualify at the higher interest rate environment? Will the Fed determine that inflation is beginning to be under control and start to lower the interest rate environment, which in turn will bring more borrowers and buyers into the housing market? Time will tell. Thanks for watching this video, and I hope the information presented has been helpful to you.